Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm happy to have my longtime friend on, Danny Becker from CBRE. Danny, how are you doing?
Hey, I'm doing well, Michael. Thanks for having me on.
So Danny is the Executive Vice President for CBRE based here in Dallas, Texas. Sells as much, him and his team sell as much or more than pretty much anyone in town. I mean, you guys done quite a bit. So Danny, maybe give everyone a little brief background on yourself. How did you get here? If you can't tell from his accent, you're not originally from here, right?
That's right. I grew up in Milwaukee, Wisconsin. Moved here right after college about 11 years ago. I've been with CB for all of that time, since 2010. So long-term CB employee. I spent 1 year in the research and consulting group and then been on the transaction side for decades. So seen a lot of things, worked on a lot of interesting things, and it's been a lot of fun.
So investment sales pays a little better than research?
It tends to, yeah, if you're good at it.
Yeah, it either pays more or less depending on how much you sell, I guess. So for a little bit of perspective, maybe kind of talk through the last couple of years of sales volume for your team. Well, one, who's all on your team? Like how many team members you guys have? And then what's kind of last couple of years worth of sales volume so the viewers can get a little perspective?
Sure, absolutely. So I co-lead the multifamily investment sales platform here in Dallas with my partner, Jeremy Faltis. We have Kevin O'Boyle, Chandler Sims, Anita Stewart, Chris DA, and William Hubbard. So there's 7 brokers total. Each broker has a little bit different niche or skill set. But in general, we can cover the entire market from 60s and 70s vintage, older product to brand new construction, high-rise product. So we're fairly uniquely positioned in the market where we have a skill set and capability to execute for clients from individuals, syndicators, closed-end funds, and large institutions.
And what kind of sales volume have you done the last couple of years? And what kind of basic percentage or rough percentage of the overall investment sales markets do you think that is in multifamily for Dallas-Fort Worth?
Sure. Last year's a little bit of a peculiar year, but according to Real Estate Alert, we're the #1 market share here in DFW, approximately $1.8 billion in total sales volume, which was down slightly from 2019 and 2018. 2018 was about 2.5 to 2.7 billion, and 2019 was in that same range. So down, but not substantially so.
We'll sell, 10 to 12 billion of multifamily transactions a year in Dallas-Fort Worth in a normalized year or something like that?
Actually, last year we did. So last year, the total market was approximately $10.3 billion. Couple of things to note there. There were a few larger transactions that made that number look bigger than it actually was, but the fact remains that Dallas-Fort Worth is the most liquid commercial real estate market on the multifamily side. It was in 2020.
Well, you say that, but every year it seems to be there's always that one little large portfolio that always skews a number, and every year there seems to be that, the next one that comes up and sells. But maybe that's a good way to talk. So you've been selling apartments about a decade now. What's kind of like really kind of the pre-COVID evolution to kind of where we are today? We're kind of towards the latter part of Q1 2021 as we record this. What's kind of different from say 2-3 years ago? How's the market functioning different today from then?
Well, one thing has stayed the same except for the first 6 months of last year. Or really the second quarter of last year. One common theme in this market is an extremely high level of liquidity and investor demand. We live in the best market in the Sun Belt, in my opinion. Others would argue Phoenix. But if you look at the 3 top markets in the Sun Belt region of the United States, it really is Atlanta, Dallas, and Phoenix. We are comprised of the things that really drive apartments, which would be net immigration and job growth. Not to make it too simplistic, but that's what it is. I mean, and you look at the demand side of the equation, and that's where you want to be investing in apartments, and it's population growth and job growth. So we have both of those things. So to compare where we are right now to 3 years ago, I would actually argue that we're in a supercharged environment right now. COVID really accelerated some demographic trends that were occurring already 3-4 years ago that fueled our cycle, the latter part of last cycle. It accelerated dedensification of urban areas. So right now we're experiencing significant net immigration from both coasts, really the tri-state area in California, as well as Chicago. So I believe that what we experienced last year is an accelerator effect that really is going to push DFW into a position of being a market leader the next 10 years.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
That's the demand drivers, but we have like, always lead the nation, or, neck and neck with New York City leading the nation, and new deliveries as well. What are you seeing as far as like equilibrium? Have we been able to kind of keep up with the deliveries with absorption for the last real decade, I guess?
No. But we're not far off.
Yeah.
I think is the point. Last year we led in apartment absorption across the entire, leasing was down, but we led the country in apartment absorption because of the things that we just discussed. But we are in a market where we have experienced higher levels of supply. But let's be honest, the reason that developers are building assets here is because people are moving here.
Sure.
So as a total number of units delivered in 2020, we did not meet that demand. I do believe this year will be pretty close. But one thing that's really interesting on the supply pipeline is we permitted 44% less units last year than 2019.
Okay.
So given that fact pattern, I believe that there will be a gap in the supply pipeline in the next couple of years, and very quickly, any of that excess supply that's in the system will be absorbed and things will change. And not that we're in a bad state or wildly off equilibrium, we just tend to build a little bit more than we need, but it does get absorbed. It just doesn't happen exactly in that calendar year.
So historically, the last 4 or 5 years, we've been somewhere in the 40 to 50,000 units under construction at any one given time, delivering somewhere around half of that at any one year, right? So we're having 20 to 25,000 units, give or take, deliver every year, absorbing the vast majority of that. So we're generally in equilibrium. And what you just said is we had about half off the number of permits in 2020 versus 2019. I think the number you told me the other day before we started recording was 27,000 units were permitted in 2019 and about 15,000 were permitted in 2020. Is that correct?
That's correct. And just one qualifier for that, the way that the Dallas Federal Reserve Bank tracks that data is by number of units in a structure. So they do 1 unit, 2 unit, 3 and 4 is lumped into one category, and then structures with 5 units or more. Right. So if you look at the larger apartment buildings, 100 plus units, not all units that have 5 units or more are 100 plus, obviously.
Sure.
So 15,000 units were permitted last year, down from 27,000, so about a 44% contraction in permitting activity last year. So yes, that is a substantial amount of contraction in permitting activity, and I believe that is going to lead to an accelerator effect in our market.
And so that would be units that would have delivered in, say, late 22 or somewhere in 2023, generally, because it takes couple years from permitting to actually leasing units. I think you couple that with the headlines that you read is lumber's up double to triple, labor, land, all the input costs of this development is going up and up and up. So we're seeing ever escalating costs to deliver some of these product as well. So we have less product and escalating costs. So you would think that the new delivery pricing for these developers to exit and make a profit have to be ever escalating. I don't know if you have any comments around that as well.
Sure. We recently capitalized an asset not too far from here, actually, and the cost for that building was just over $273 a foot. So, so yes, I mean, we are feeling the pressure of escalating hard costs and soft costs. And frankly, we've been in a development boom on the commercial side, not just multi, but commercial in general. model for the last decade. So availability of sites is significantly less than what it was 10 years ago. So if you ask some of the developers, where they're building right now, a lot of the groups that are building garden style product are having to go much further out than they were 10 years ago. So I believe the barriers to building are definitely higher than they were 10 years ago, coupled with the permitting activity. And I think there's going to be a pullback in the supply pipeline. And frankly, there probably shouldn't be with the amount of people moving here. We have 7.3 million people that live in this metroplex. By 2030, we're forecasted to have over 9 million people living here. We probably should be building units for these people to live in. And you look at where we're at on the single family side of things, 1.4 months of supply.
Yeah, wow.
Equilibrium, 5.5, something like that. 1.4 months of supply. You go to an open house, there's 60 plus people milling around. I mean, we are potentially in the middle of a housing shortage right now if you take the housing stock as a whole, not just the apartment side of the equation.
And so so obviously rent's going to project to go up. Will you have any sort of sense on, I know CBRE has a large research department. You were there for a cup of coffee. What is that looking like? What is kind of the house view or your personal view kind of going forward? What are we seeing for rental rate growth?
So the data that CBRE Econometric Advisors has broadcast for the calendar year 2020 is just over 3% market-wide rent growth in Dallas-Fort Worth this year. The accelerator there is 2022, 6.3% market rent growth.
Oh, wow.
If with an inflation target of 2%, I mean, that's very serious rent growth in 2022. And with your timing that we were talking about before, a potential pullback in the new deliveries in that late 2022, early 2023 timeframe, I mean, we could be looking at 5 years of above inflationary rent growth through the recovery phase of this cycle into the growth phase.
So greater than 6% potentially kind of going forward would not surprise you?
It wouldn't surprise me. Maybe it doesn't sustain 6% through 2024, 2025, but I would believe 3 to 5% rent growth during that period of time. That's my personal view, not the view of my friend.
So with the population coming here, pullback in supply, projected rental rate growth, the capital has to just be flowing in, right? So what's kind of the market participants from a capital perspective right now, and how is that different than a couple 3 years ago?
The last 10 years, really since 2010 to 2019, our market changed in complexion of capital. Pre-2010, our market was largely a private market, private capital, private investors, syndicators. 2010 to 2019, because of the growth characteristics of our market, institutional capital started showing up materially more on bid sheets in our market. Now, I believe that is a trend that's going to continue. I believe that trend continued to solidify itself with the demographic changes that we saw last year that accelerated. So I believe that the complexion of our market is going to be much more institutional on a go-forward basis. For instance, some of the publicly traded REITs have gotten board approval to deploy capital in this market. Now, these are investors that have historically played in gateway cities, coastal markets. So the fact that a couple of those investors are now looking to deploy capital in a non-coastal Sunbelt market, I think that's just one anecdote where there are many more out there that would solidify that point. So as far as where I feel we are right now on the capital market side, as far as investor sentiment, investor interest, I'm on the phone all day. Every broker's on the phone all day. We are fielding a lot of calls and having a lot of discussions with existing clients of ours, clients of the firm from other markets, and investors that are coming from other product types. So the inflow of capital into our market, really the inflow of capital in the apartment sector and the inflow of capital into the apartment sector focused on Sunbelt cities right now is palpable. We have discussions with investors from California, from the West Coast, from the East Coast, family offices, 1031 investors that are looking to redeploy proceeds into DFW, institutional investors that need more Sunbelt exposure, that are reallocating within their portfolio away from office and retail and reallocating that capital into multifamily and industrial,
Yep.
which are the two asset classes that really we're seeing the target of the reallocation game right now.
Okay.
As well as a lot of the larger closed-end funds and operators that have never been in this market before that are now here actively acquiring assets. So I believe from a demand perspective in the capital markets that we've never been at a point in time where the demand for apartments in this market has been this high. We've been in a very good position for 10 years.
Yeah.
Don't get me wrong. We've been in this was a very robust transactional cycle for us, 2010 to 2019, with similar, if not heightened, growth characteristics on the demand side of the equation from a population and job growth perspective, coupled with heightened capital demand for apartments in this market. I believe that this market is extremely healthy right now.
So we got unbelievable demand. We're having projected rental rate growth that should accelerate. We're having costs accelerate to build this stuff. We're having hard times getting sites. This money's coming in, and that institutional money now they're allocating to the Florida, Arizona, Texas, Georgia, where they maybe wouldn't have been so heavy. Maybe it would have been more New York, DC, California focused. Is that money also coming into suburban, or are they focused on urban core? And is that new money, kind of the institutional money, coming into only brand new development, or are they also looking into the workforce housing?
Yes.
Everything?
That's a great question.
Yeah.
And we could sit here and talk for 3 hours about that. So the suburbs have the hot hand right now from a rent growth perspective. Our infill market has been in somewhat of an oversupply state for a couple of years.
Yep.
I think that's going to change. I think that's going to change probably sooner rather than later. But
that supply's shifted to the suburbs right now, right? The new development.
So a lot of the new development, yes, there's more supply coming in the suburbs. There's definitely still some supply in the infill market that we're going to have to work through. But COVID shifted renter preferences to the suburbs. So we're seeing outperformance in rent growth in the suburbs right now.
Yeah.
I believe that the infill market's going to come back from a fundamentals perspective pretty quickly, and I think that light can turn on very rapidly.
Okay.
So we're seeing the capital come to this market, and there's not one specific theme. The theme is we want apartment exposure in high growth markets like DFW that has a highly diversified economic base. So we are seeing a lot of the private investors looking for exposure more in the suburban markets, and a lot of that capital wants some sort of value add component to the property where they can manufacture yield and be in charge of what that profile looks like. The institutional capital historically has looked at development and infill markets. We are seeing some shift in that strategy to more. We're even seeing some institutional investors buy workforce housing assets and shifting strategies and definitely deploying capital into value add. And there are those groups that are still looking for infill. So at this point in time, there isn't one specific theme there. I guess the theme is that investors want apartment exposure here, and whether it's an infill asset or a suburban asset, there are going to be investors and buyers for that product.
So with this institutional money coming in, the people that are already here are probably doubling down. They're not going anywhere, right? Guys like me are still buying and staying here. And the suburban, irrespective of grade, is extremely hot. What are you? Would it make sense to you, in your opinion? What's kind of the best opportunity you see right now, in Danny Baker's personal opinion? Because we've been historically buying a lot of suburban stuff, so I'll kind of just talk about what we've been focused on. You've seen a lot of what we've done. Started in the workforce housing, traded up into kind of better quality suburban, straight from the developer, Class A stuff to kind of A-. And now I'm looking at all the stuff that you could buy kind of in the urban core or next to the urban core, and uptown Oakland, East Dallas, some markets like that are in town Fort Worth. And you could buy it, at or below current replacement cost. And there's the supply that used to be extremely robust, and a lot of it coming is now tapered off to next to nothing. And so it seems like that might be the place to kind of zag, as everyone's going to the suburban market. So you have any thoughts on that kind of basic thesis or strategy?
I would say, my personal opinion, if it's an apartment building where people live in it and pay rent, you can make an investment case for buying that asset.
Okay.
Apartments have, for a very long time, and I believe is one of the best hedges against inflation. So either we're going to be in a low rate environment for a long time with not a lot of inflation, with the target at 2% on the 10-year. 10-year inflation target, or we're going to experience inflation. Apartments are going to be an exceptional place to be invested. So I like personally right now, I think that the suburbs are extremely competitive. They're competitive for a reason. So I think there's definitely merit to buying assets in the suburbs because there's rent growth there and renter preferences are there. It's difficult to buy in the suburbs right now for high quality assets because of how competitive it is. I like newer constructed assets. Right this particular moment, there is a little bit of a gap in the capital markets for that product because of the supply issues that we have had over the last couple of years. So to your point, if you can find an asset that's a little bit newer and you can buy it below replacement cost, then there's definitely merit to that too. Our infill market right now, I don't think there's going to be a lot of trades in that market until there's some semblance of rent recovery, which will likely happen a little bit later this year. But I like the infill market. I think Uptown is very cool. I think Deep Ellum is very cool. I think Bishop Arts is very cool. So I think as Dallas develops as a city and more people go back to work, I think the infill market is going to turn around extremely quickly. So to answer your question, not intentionally being invasive, I just think apartments are a great place to be right now, and you can make a case for really any asset class and location here.
So speaking of that, I think it's really helpful for people to kind of understand like the current state of the market. You recently had a couple, 2-property portfolio, I think it was, that went off and was pretty aggressive in the bidding process and the interest to it. Do you have maybe a deal story or two you can kind of share about kind of recent trades or recent deals that you marketed and kind of that illustrates the level of demand that's going on right now?
That would be a good one. It was a 2-property portfolio, workforce housing, 8-foot ceiling product, in pretty good workforce locations with, call it 80% of the units left to renovate. So there was a lot of value add upside to both of the properties. We ended up having 50 tours across both properties, 35 bids in the first round. We took a handful of investors officially into best and final. Some of the groups that didn't make the cut wanted to participate in the next round. We made, I think it was 7 calls or 6 buyer interview calls, and then we selected somebody. But that bid sheet is a perfect example of the profile of capital that's looking to deploy money in this market. We had institutional money, we had private syndicators, we had family offices, we had 1031, and we had a couple of closed-end funds that were looking to acquire those assets. So it was really every type of investor showed up on that bid sheet, and it was very aggressively bid because it had some of the markings that a lot of these investors look for. 8-foot ceiling workforce housing, which is a big mandate for a lot of groups. A lot of upside potential in classic units. Very good workforce locations near demand drivers, medical and industrial logistics. And they priced below replacement cost. So if you have those things in scale, that was a $60 to $70 million transaction between the 2 properties. You're really hitting the meatiest part of the bell curve as far as capital demand goes.
And so I know I lost my train of thought earlier, but what I was going was we got replacement costs escalating, supplies coming down, interest rates are historically low, demand is crazy. We project higher rental rate growth in the future. Like, how the hell are you going to compete in these deals, today, let alone 2-3 years from now? It seems like get your knife out, right? It's a knife fight, and it's going to be hard. And if I want to buy deals in 2021 and I want to buy deals in 2023, 2024, where do you need to position yourself if you're kind of coming to this market? You're not in this market. You want to come to this market and get in here, or maybe it's Phoenix or Atlanta or wherever. It's probably relatively similar across. Any advice or any sort of tips if you're trying to break into this market?
Yeah, that's a question that I get often. We have some investors that want to be here that show up and they submit a bid in the first round without really digging in, thinking that they're going to be able to participate in a competitive process and get a favorable look or treatment. we want to treat everybody fairly, but our responsibility as brokers is to represent our client and curate a bid sheet and make the market with the most highly qualified and aggressive capital in the market. So if you're new to this market, it's good to make contact with and build relationships with market participants, whether that be a sponsor if you have equity you want to deploy and use that equity in a joint venture type structure, or if you want to buy direct and you're an operator. It's good to make contact with market participants so they know who you are when you go and tour a property. That being said, but one thing to add to that would be, when you're underwriting a property and touring a property and bidding on a property, ultimately, you want to be able to convince the broker that's representing the seller in the transaction that you are qualified to buy the property, you have the equity and the debt lined up to buy the property, you've done a thorough due diligence, especially for new entrants to this market, understanding property taxes, understanding insurance, and things that are things that don't necessarily translate exactly from market to market. Being able to elucidate that to capital or owners rather would be highly important. I would say. So being dialed in on your capital stack, being dialed in on how you're going to get the property closed, and giving the broker comfort so he can relay that to the seller that, yes, this investor has spent the time and the diligence to get to this point in the process and they're qualified to buy the building.
And are you still got to come in town, because a lot of these institutional groups wouldn't even get on an airplane up until recently. Maybe some of them still aren't, I don't know. And it just seems like it's going to be really challenging. So you need to start spending time in the marketplace too, because I mean, they got to go against a guy like me that's got a decade or better going to the bar and shooting stuff and golfing and all that kind of activities with all the market participants, like you mentioned. And it's a completely unfair business. And you got to fight guys like me and, Charlie and David down the hall over there. And I mean, it's going to be a little bit of an uphill battle. So I think it's really about getting into the market, like you said, spending time showing your face and getting people to know, like, and trust you, on top of all those fundamental things that you mentioned. Because at the end of the day, it's really kind of a lot of this stuff is like a soft skill business, and it's on the margins. Those little soft skills kind of make or break a lot of these deals, for sure. So with all that said, is there any deals that you guys have coming up? What's kind of like, as we're kind of exiting the first quarter going forward, any deals that you kind of have coming up that maybe you could share with the viewers and kind of get a flavor of what's happening right now and not what happened a month or two ago?
Sure. So last year was an extremely high level of transaction activity. A lot of that was weighted in the back half of the year. That's a lot of trades in 6 months, $10.3 billion. Now, not all of that happened in the last 6 months, but a lot of it did. Going into 2021, the environment dried up a little bit from an opportunity perspective. That's not just here. That's in Houston. That's in Austin. That's really across the entire Sun Belt.
Is that because we didn't have an NMHC this year, so there was no natural driver to do that? Plus, kind of coupled with a lot of these trades that would have been spread out through the year, all were concentrated, like you said, the fourth quarter largely.
That's part of it.
Yeah,
that's definitely part of it. Having NMHC in a conference where everybody gets together and discusses their strategic plans for this year, and having available opportunities to take to that conference that's part of it. I think the other part of it is we never really had the large delinquency issues that other parts of the United States had. So owners here are still collecting the vast majority of the rent. But there are some owners out there that are having some delinquent buildup behind the scenes, and how to deal with that in an environment where there's an eviction moratorium. So not that it's a major problem, but just understanding how capital's going to underwrite through that and how the lender's going to underwrite through that has been an important discovery phase of the first part of this year. And I think that we're going to start seeing significant transaction activity coming in the next 30 to 45 days. It's already starting to happen. There are properties starting to hit the market. But I do believe quarters 2 through 4 are going to be extremely robust. And I think we'll probably be back generally to where we were last year from an activity perspective, maybe even higher, which is a fairly profound statement, frankly, with the amount of activity that we had last year. So what's happening right now? So as a leading indicator, the tip of the spear, so to speak. The amount of BOV activity that we have right now and some of our peers and competitors have.
Sure.
That's a long list.
Yeah.
So we're working long hours. We're at the point where, it's all hands on deck to manage through the BOV activity and valuation requests that we have from our clients to prepare assets for market. So I think that there's about to be a lot of properties in the market.
Where roughly are you on your number of BOVs you're working, and how does that relative to historical norms?
28.
28. What would you normally be doing at any one time?
Any one time, we're always busy.
Sure.
We have 28 right now, and I feel like a higher percentage of those are live fire drills as opposed to, hey, just what's the spot value of my asset in the market today? So we're busy. I think everybody's busy.
Is that double what a normal time period would be for you?
If you just pull a random date in a random year the last 36 months, yeah, we're probably underwriting 10 to 15 properties at any given point in time. So yeah, probably about double.
And then you have a nicer new kind of A asset and maybe a little bit more workforce asset that you're about to bring out. Maybe you can share what that looks like right now.
Sure. We have a Class A value add asset in the northern suburbs that will be fully in the market next week.
Okay.
We launched the Coming Soon earlier this week. Extremely high quality garden product. It was built by an institutional developer. It's been institutionally owned for a long time. So the property's in exceptional physical condition.
Okay.
The current owners renovated some of the units. In my opinion, the scope that they've done is really nice, but that submarket would substantiate doing hard surface counters and taking what they've done to a little bit higher level.
Okay.
And additionally, you have the classic units that have not been touched. So that's a deal that'll be coming. That'll be in the $70 to $80 million range.
Okay.
And then we have a 2-property portfolio in the market right now, one in Grand Prairie and one in Arlington that's bidding in 2 weeks from now.
Okay.
So those are two that I would definitely pay attention. That's about a $60 to $70 million transaction between the 2 properties. They'll sell individually or together, and both of them are free and clear with a significant amount of value add left on the rent roll.
And so what's generally speaking kind of our market cap rate for your generic middle of the road kind of A, B, C deal? What are kind of the market cap rates today? And what is that, 24 months ago, 12 months ago, relative? How have they moved?
Down. We've seen and experienced fairly significant cap rate compression over the course of the last 12 months. Last year, we were low to mid 4 going in cap rate. And when I talk about cap rates in this type of context, I like to use a T90 revenue, T12 expenses with the pro forma tax reassessment layered in. So a real NOI, real operating expenses.
And so that was 4.5 to 4.25, irrespective of grade in 2019?
For quality value add product, whether it's 80s or 2010, the cap rates were not exactly the same, but they were generally in that low to mid 4 range. Where we are today as a result of where the debt markets went at the end of the last year, now they've moved out a little bit, but the bridge lenders have stepped into the space in a meaningful way. So you can get very accretive debt right now. So because of the liquidity on the debt side of the equation, and because of the liquidity and capital demand on the equity side of the equation, we've seen compression. So right now, it would be difficult to buy an apartment asset in this market with the 4 handle in front of it. So we're mid to upper 3s from a going in cap rate perspective. And that's not on an NOI that has significant impairment on the revenue side with delinquency or vacancy, because we haven't seen a large change in either of those line items at this point in time. So that's a real going in cap rate.
So last 12, 18 months, we've seen about 50 bips of compression. In
maybe
cap
75.
Rate. Maybe 75. And what are most of the buyers underwriting, like a year 1 pro forma cap, or most of those kind of that low to mid 4 pro forma year 1?
You can use that as a general approximation, but we're no longer a direct capitalization market to derive value. We're a total return market. So the year 1 cap rate is kind of just the implied cap rate. So we shifted from a cap rate market to an IRR market or an IRR underwriting a number of years ago. And that's where we are right now, especially with value add deals where you want to capture what the cash flow profile looks like, at stabilization in year 3 or 4, a total return is really the best metric. But yeah, I would say mid 4s on a year 1 cap rate for high quality 80s vintage product, and it'll go south of that for newer vintage assets. So the one component on the value add side of the fence is the cap rate going in matters significantly less than the total return, and what your stabilized cap rate and yield on cost look like in year 3. So that's really the metric that we like to look at, is stabilized yield on cost in year 3, and that's generally in the low to mid 5s.
So you said something as we kind of wrap up the conversation. You said something before we started recording that I thought was amazing, that you haven't sold a deal that had an agency loan on it, and however many months has been now.
This year.
So all year you haven't sold a deal that had agency financing on it. And last year it was probably almost exclusively agency financing because there was the only market that was out there. We've seen the 10-year Treasury through first part of 2020, and then kind of stayed low throughout 2020, got to, 50, 60 basis points on the 10-year Treasury. We've moved, as we talked today, roughly 100 basis points, a full percentage point up on the 10-year Treasury. What's your personal opinion on that? If I'm coming in this deal, would I go out and take a fixed rate loan on these deals? Do you think the bridge market's where it's at right now? Obviously, the market is doing a lot of bridge, a lot of debt funds, as you mentioned that those were completely gone for the better part of 6-7 months, kind of slowly turned on last year, and it seems like those the terms and everything are materially better than what the agencies are right now, just by being a guy in the market looking at stuff. What would you recommend for your clients to do? Put a 10-year fixed rate mortgage on it, float it? What's your crystal ball say?
This similar fact pattern unfolded in 2016. And what we saw a lot of clients do at that point in time is put on long-term fixed rate debt, thinking that if we sell this in a couple of years, we'll have some IO left and the debt will be accretive to the new buyer, and we'll be able to uncover a premium from a pricing perspective. I would say some lessons learned from going through that exercise 4 years ago with a lot of clients would be float your debt.
Yeah.
Unless you're planning to hold your asset for 10 to 12 years, it would be highly recommended to match your debt with your business plan, which would be floating rate debt with prepayment flexibility.
Yep.
Our market is extremely transactional. And if you want to be able to take advantage of moments in time in our market from an appreciation perspective and realize gains on assets, it would be better to float your debt than fix your debt for a long-term period of time. Now, if you're a long-term holder and you want to lock in low rates, that's probably a good business plan to put in longer term fixed rate debt. But just from a flexibility perspective, if you're buying a value add deal that you intend to sell in 3 to 5 years, right now, bridge capital is an extremely accretive avenue from a debt financing perspective to explore. And having flexibility on your prepayment penalty would be something that I would highly recommend. And lastly, don't ever meet your maturity. Have an exit strategy in place going into the building. Maybe you don't know exactly what month you're going to sell it. Everybody's going to model we sell it in month 36 or 48 or whatever. But always have an exit plan in place materially prior to when your loan matures.
Yeah. And so I would deduce that your view is that this run up in the 10-year Treasury is probably towards the later endings of it, and you think that we might pull back on the 10-year Treasury, or do you think we still have some room to run on the 10-year Treasury and we're going to see north of 2% for the better part of the year?
I don't know.
Yeah.
I wish I did. Like I wish I could sit here and say they're going to be X in 3 months, but I believe that the Fed is going to intervene and the 10-year Treasury yield is going to come down. I don't know to what level, but I believe they're going to come back down and be at a sustained level for a couple of years. One thing I will mention is the two indexes that are down, as we sit here today, LIBOR and SOFR.
Yeah.
So floating rate product is extremely attractive right now, especially with rates moving the direction that they have over the course of the last 30 days.
Yeah, no doubt. So Danny and his team at CBRE sell, as I mentioned, as much or probably more than anyone in Dallas-Fort Worth, a certainly have a pretty robust team, and they sell anywhere from your lowest workforce housing, C-class stuff, all the way to brand new Class A. Sell several portfolios with their other offices across Texas and the general Sun Belt. So, Danny, if people want to get to know you, learn a little bit more about your listings upcoming, what's the best way for people to get some information about you?
Call me or email me. So you can find me at danny.baker@cbre.com. Please call. I love to talk to investors that are either here already or investors that are looking to buy product in this market. And we pride ourselves on sourcing capital and bringing new investors to the marketplace. So please feel free to reach out. I would love to have a discussion with you should you have any questions for me or anybody on my team.
Well, Danny, definitely appreciate your time today. So for Danny Baker, I'm Michael Becker. We'll see you guys soon.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.